Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, a channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I will continue a new thing I'm trying for 2025 for the new year. If you comment on this or the other videos that come out in February, I will put you in a draw for 1 hour one-on-one mentoring call with me, a $50 value. We can look at your portfolio, talk about financial independence, personal finance, retirement, whatever you like. So comment below. Up to 4 entries are allowed, 1 per February video. I had a YouTube video question about Canadian Depositary Receipts, or CDRs. They were initially introduced on the NEO exchange in partnership with CIBC, and recently BMO started their own set on the CBOE exchange, which bought the NEO exchange. So here's a brief overview of Canadian Depositary Receipts, CDRs. First is the currency exchange fluctuations. The CDRs trade in Canadian dollars, and CIBC adjusts the ratio of depository receipts to company shares daily to account for changes in currency values. CDRs come with a built-in currency hedge, which minimizes the impact of currency exchange fluctuations on the value of the investment. This means that changes in the exchange rate between Canadian dollar and the trading currency for the underlying shares do not affect the investor's returns. So as the US dollar fluctuates versus the Canadian dollar, it has no impact on the value of the CDR, and the CDR just reflects the movement of the original stock. Let's take a look at fees. The bank charges no management fees for CDRs directly, but earns fees from the foreign exchange transactions it makes in the background to manage the currency hedge for investors. The maximum spread between rates that the bank can collect from those transactions is capped at 60 basis points, or 0.6% on an annualized basis, which is significant. Investors may also incur trading fees when buying or selling CDRs, similar to regular stocks. Let's take a look at strong versus weak Canadian dollar. So when you're buying CDRs, a strong Canadian dollar is generally better because it means you can buy more shares of the underlying foreign stock for the same amount of Canadian dollars. Conversely, a weak Canadian dollar would mean you get fewer shares for the same amount of Canadian dollars. Let's look at stocks with CDRs. At the time of recording in February 2025, there's 85 CDRs. CIBC CDRs provide an exposure to a variety of global companies, totaling 80 at this point. Here's the list. Pause to view or visit CIBC's website. BMO has their initial lineup limited to Mercedes-Benz, Nestle, Toyota, Honda, and Nintendo to follow. They like world car companies, apparently. CDRs are traded on the CBOE Canada, formerly NEO Exchange, making it easier for Canadian investors to invest in international companies without the need for international brokerage accounts. And generally, the big benefit to using CDRs is that you can use Canadian dollars to buy them and get US stock exposure without paying the 1 to 2% penalty or spread that brokerages or your bank will charge to exchange Canadian dollars to US dollars, or you don't have to go through the trouble of using Norbert's Gambit. So let me know if you use CDRs in your portfolio and what the experience has been, and to enter the draw for the one-on-one hour of mentoring for February. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.